Today we're stepping into one of the most talked about, and frankly most misunderstood, areas of modern finance: tokenized commodities and digital asset trades. Every week you'll hear headlines about tokenized gold, tokenized oil, even tokenized real estate. The pitch sounds simple. Take a physical commodity, back it with a blockchain token, and suddenly you've created a more liquid, borderless asset. But here's the problem. While the theory is elegant, the practice is messy, and most of what's being marketed out there today falls somewhere between half-baked utility and pure hype. Let's break this down. First, the promise. Tokenization, at its core, is the process of representing ownership of a real-world asset, like gold bullion in a vault, through a digital token on a blockchain. Done correctly, that token should act as a legally recognized claim on the physical asset. It should be transferable 24/7, divisible into micro-shares, and free of traditional clearinghouse delays. In theory, this gives us a path to make illiquid or bulky assets, like a ton of copper cathodes or a bar of gold, as easy to trade as Bitcoin. And that's why you see major banks and even regulators exploring tokenized asset frameworks. Now, the problem. Most so-called tokenized assets on the market today are not legally enforceable claims. They're representations, promises, or sometimes just cleverly marketed IOUs. A token that says it's backed by gold often doesn't survive a simple question. Where exactly is the gold stored? Who audits it? And how can I take delivery if I choose? If the answers aren't clear, then the token is not a commodity. It's just a digital derivative with trust issues. Another problem is compliance. Commodities markets already operate under strict rules: custodial standards, KYC, AML, escrow protocols, delivery obligations. If tokenization doesn't integrate with those systems, it's not solving the real friction points. This is where SKR protocols come in. An SKR, or safekeeping receipt, is the traditional backbone of commodity finance. It's a document issued by a secure custodian confirming that an asset, say 100 kilograms of gold, is being held on deposit. Historically, SKRs have been the proof that traders, banks, and buyers rely on to confirm that a commodity exists, is real, and is under professional custody. Now imagine merging the SKR world with blockchain. That's where tokenization has real potential. If a digital token is backed by a verifiable SKR from a licensed custodian, and that custodian has a legal obligation to deliver, then suddenly the token is not just a shiny tech gimmick. It's a true hybrid instrument, blockchain speed with old-world custody trust. So where does this leave us today? We're in a transitional phase. Some tokenized commodity projects are genuine pilots with credible custodians, proper legal frameworks, and regulatory oversight. Others are pure hype, digital wrappers with nothing inside. As professionals, we need to learn how to separate signal from noise. Here are 3 practical filters I recommend. Auditability. Does the project provide independent third-party audits of the underlying commodity reserves? If not, walk away. Delivery mechanics. Can you actually redeem the token for physical delivery, or is it just perpetual trading? True commodity tokens must have redemption paths. Escrow integration. Does the system integrate with real escrow rules for international trade? If not, the token has no value in large-scale cross-border deals. Now let's talk about the future. By 2025, I expect we'll see a dual-track market. On one side, regulated, institution-backed tokenized commodities that behave like tradable warehouse receipts. These will be slow to grow but highly impactful once adopted. On the other side, we'll continue to see speculative crypto commodity tokens marketed to retail investors with little or no backing. The winners will be those who bridge blockchain speed with commodity market discipline, audited custody, escrow compliance, and clear legal frameworks. And this is where the gated content comes in. Because what I've given you here is the
and the
overview,
filters.
the promise,
But
the
what I haven't
pitfalls,
yet
and the
shown
filters.
are the specific deal structures.
But what I haven't
the
yet shown
escrow
are the
rules
specific deal
that actually
structures,
work in
the escrow
tokenized
rules
trades,
that actually work
and
in
the real
tokenized
examples
trades,
of SKR
and the
linked
real
digital
examples of
assets that
SKR-linked
have been
digital
tested in the
assets
field.
that have been tested in the
That's the
field.
level of detail we cover in
That's the
insider
level of
video
detail
on
we cover in the insider video on
tradeskr.com. If you
tradeskr.com.
want to see the step-by-step execution,
If you want to see the step-by-step
tokenized
execution of
asset deals
tokenized asset
with
deals with SKR protocols, and learn how escrow is evolving for 2025, that's waiting for you inside the gated section.
The hype
around tokenization isn't going away, but neither is the need for serious compliance, custody, and escrow.
If you want to separate use
from hype and actually learn how tokenized asset deals are executed in the real world, then head over to tradeskr.com right now.
Watch the insider video,
get the deal mechanics, and arm yourself with knowledge that most people never get access
See you on
to.
the inside.